Welcome to Indianomics. Next week, the MOSPI, or the Ministry of Statistics, will announce the fourth quarter and the full year GDP for last year, FY24-25. The CNBC-TV18 poll shows that the GDP for the fourth quarter grew by 6.8%, much stronger than the 6.2 in Q3, 5.6 in Q2, and 6.5 in Q1. GVA growth, gross value added growth, will be more modest at 6.5%, or 6.2 Q3, 5.8 in Q2, and 6.5 in Q1. For the full year, our poll, that is for the current year, our poll threw up a GDP growth of 6.3% only. That is the FY25 poll, compared to MOSPI's estimate of 6.5. We are still speaking FY24-25. And last year, of course, FY24, it was a solid 9.2%. Now coming to the current year, FY25-26, our poll threw up a number of, again, 6.3%. This compares with the Reserve Bank's forecast of 6.5%. Now, let's go back to FY25. If FY25, the numbers are way below even our poll's estimate of 6.3%, that can move the Reserve Bank to cut rates a little more aggressively. So the Q4 numbers are important for the upcoming Reserve Bank policy. It's the last data Reserve Bank gets before it goes into policy. Hence, to understand more as to what to expect, I have with me an elite panel of economists: Kaushik Das, the chief economist at Deutsche Bank; Aurodeep, Nandi, the economist from Nomura, India; and Anubhuti, Sahay of Standard Chartered India. Gentlemen and Anubhuti, thank you very much for your time. Kaushik, well, the first question will be, we had a terrible shocker in the second quarter when we saw 5.6%. 6.8 is very respectable. Can you stand by that number? Have we seen enough evidence for such a strong growth?
Good morning, Latha. Our forecasts are exactly what you have just talked about, that our real GVA growth is around 6.5 for January, March of 25, and the real GDP growth is 6.8. As you mentioned, that this is coming from 6.2 in October, December, and the shocker that we got 5.6. Whatever I've seen in the leading indicators, I think we will get some sequential improvement in real GVA, which is more easily understandable and probably show some improvement. Now the GDP calculation is more tricky because it brings in this element of calculating net taxes, subsidies. And what I just calculated and saw is that subsidies were down in January, February by about 34%, and January, March, my estimate is subsidies will be down minus 40%. So it is possible that you could get a little bit of improvement in the real GVA to 6.5, but my guess is that your real GDP growth could be even higher than 6.8, probably higher than 7% if these subsidies remain negative. If you remember that the CSO's implicit estimate for January, March GDP growth is 7.6, and that's why they've given that 6.5% average growth for FY25. We are at 6.3 because we have 6.8% for real GDP growth. I will stand by that, but I think the risk is more to the upside than the downside.
Oh, that's good news. I will come to what the Reserve Bank will make of it. But it is important to remember that the MOSPI's subtraction, if you subtracted from their full year number, we did get a 7.6 for the Q4. So the upside surprise is possible. But Aurodeep, you do a heat map. I remember it was very popular with us during COVID. Now, the crop figures for the first count didn't sound very good, if I remember right. So can there be that kind of disappointment, agriculture or something?
Well, Latha, on the supply side, I think it's going to be better news because Rabi crop production has been good, so agri GVA growth should be fine. However, industrial growth, I think, is going to be weaker. We see this also in the IIP numbers, and services we expect should be better. The heat map that you refer to, if you in fact look at how consumption indicators have done this quarter on a year-on-year basis, it's actually moderated. We do a coincident activity indicator growth, and I mean, we are expecting that there should be moderation in private consumption. possibly moderation also in investments and exports. However, imports, the negative part of it, is likely to be higher, so more negative numbers. So the GDP growth number picks up. Also, the point which Kaushik mentioned is really important, which is the sort of GDP's GVA plus net indirect taxes. So the improvement in GVA is it's incremental, 6.2 to 6.5%, and then you have also this arithmetic component that boosts up.
Yeah,
GDP
the
growth.
GDP, yeah. Okay, so are you also saying that an upside surprise to 6.8 is possible?
I mean, our baseline number is 6.7%.
Okay.
Again, there is a lot of volatility in the way GDP numbers come out. So,
Yeah.
I mean, that could be the case. But overall, I mean, I would be focusing more on the components of growth. And then if consumption is weakening and investments is weakening, I think that's the story to look at.
Okay, got that. I agree with you on this volatility of numbers. So, Anubhuti, to you, two questions. One, the GST numbers were still quite strong, so indicating that consumption should not disappoint. What are your thoughts on what might boost the GDP? And I think the more important worry for all of us is whether previous numbers will be recast. Any light you want to throw on whether they will upgrade Q2 numbers, which was the big disappointment? Any such expectations or fears?
Sure, Lata. So I think on consumption part, the first question which you put forth, I think, yeah, if we go by the broader set of indicators, we have a composite indicator and it tracks the non-agri and non-GVA growth, GDP growth pretty well. And it has stayed absolutely flattish vis-a-vis where it was in the December quarter. So there is no uptick to say so. Even if you look at, say, retail digital payments, which RBI gives, and club it with cash, cash transaction or ATM withdrawals by retail, it has actually decelerated. So it was averaging at close to 20% for the first 3 quarters of FY25. And in the last quarter of FY25, it has actually dropped all the way down to 14%. So I really don't see possibility of consumption actually surprising on the upside. It might be actually lower, and that would.
No, I agree with you. On at least two-wheelers, I clearly remember Jan, Feb, our analysts were grumbling about two-wheeler sales not being good. So, okay, so you worry that Q4 consumption may be lower. Is your overall number therefore lower?
Yes, it is lower, Lata. So, based on what even Aurodeep mentioned, so consumption, if we go by on-the-ground indicators, doesn't show an uptick. Investment, yes, government started spending, but would it have been a massive increase? I doubt. So our GDP forecast is at 6.5% for the last quarter, and GVA is 6.2. But the GVA is also getting a lot of support in our view from agri. Last March, agri growth was just at 0%. So there is a favorable base effect, and a modest uptick in output can also make it look better. On your second question, I really don't know how the growth numbers would get revised for the last 3 quarters. There have been massive revisions, but it's highly possible that we might see an upgrade in the second quarter, GVA as well as GDP number, because usually in the past, if you look at analyst forecast, the first print of GDP and then the subsequent revisions, I think then the error margin reduces. It was a shocker, so it's possible that we might see an upgrade there, and therefore the growth rate across the year might look far more uniform than what we think at this point in time.
Okay. I will come back to the revisions to both of you in a minute. But I think the more important point is the upcoming policy. Kaushik, are there any likely downside surprises or shocks that might propel the Reserve Bank to be even more dovish? At the moment, they have a lot of support from the inflation numbers. For the full year, it is expected to be under 4%, so they have that confidence. But if growth doesn't need a crutch, you don't need to cut so much. So do you think there can be any shockers, any inputs from the GDP numbers for Reserve Bank?
So, Latha, optically, suppose you get a number like 7.5% on GDP, which says CSO is implicitly, showing in their forecast. Obviously, that will make markets a bit cautious about the fact that is growth that kind of, on a slowdown path that people had thought? And then people will also think about FY26, given that there's been a reversal of tariff for China. Generally, the mood is becoming, more positive than what it was. So all these things can happen, but we also got an inflation number which is pretty low, and it'll remain like that. So if you think about RBI in the June policy, they will have to reduce their inflation forecast from 4% to, our current forecast is 3.5. I don't know whether RBI goes that low, but they definitely have to lower their forecast. GDP, they, I think, will not touch at this point of time, just having revised from 6.7 to 6.5. But on the margin, you're still revising inflation lower. And the fact that you've turned accommodative in April, so suddenly in June, if you come and pause and, you say that, for whatever reason, you're not doing a rate cut, that will be more confusing, particularly because you've turned accommodative. So I have a call for June 25 basis rate cut. But the fact that RBI, in your own calculations, which I read very carefully, and it was a nice analysis of the dividend that RBI is expected to pay, I think it'll be a big number, and you'll have an effective easing of another 25 basis points through the liquidity channel. So in June, probably you'll get almost 50 basis points rate cut, 25 through the repo rate and 25 through liquidity. So that's why I have a forecast of August, RBI remaining on a pause and not doing anything. And then if required, then in October, they'll go for another last 25 basis points rate cut, bringing it to 5.5 repo rate. And, I've written in my report that, RBI probably will not go below 5.5, because even at 5.5 repo rate, your short-term rates fall to 5.25. That's good enough. One pointer, Latha, if I may just add to this debate about the GDP growth, which can inform your discussion as well.
Sure.
In 2019 calendar year, when Governor Das had started cutting rates from 650, they had brought it down to 515 by the end of 2019. You'll see that year, the calendar year growth average was 4.7% real GDP. This time we are talking about, even if growth slows down and say it goes to 6%, it is still 130 basis points higher than that below 5% growth. Why should then the repo rate go down to 515 when your growth rate is between 6 to 6.5%? So that's why we think repo rate should be, the terminal repo rate should be 550, and the short-term rates can come down a little bit more because of the liquidity that RBI will be infusing through the dividend and what they have already done through the OMO channels.
Okay. Well, I want to come back to the policy discussion, but let me quickly get one future angle in as well, which is the current quarter. Aurodeep, of all the numbers, I find yours more pessimistic. Your, or rather, maybe realistic, who knows. Your forecast is 6%, and for the full year, you all stand at 5.8. Now, I would assume these are the global headwinds. But we've got this China rate cuts coming in. We've got, as Kaushik pointed out, huge liquidity infusion by Reserve Bank, as if what is already available is not enough. Today, the call rate is not where the repo rate is. It is at 5.75. It is already a 25 basis cut as far as the call rate is concerned. So would you want to upgrade, or do you still think that there are chances of a slowdown in the current year?
So first thing, Latha, global growth is one of the factors. The other factor is that urban consumption has been weak. It's not like we are seeing great income growth happening. And let's not forget, there's household balance sheet stress that is still there in the system. Also, private capex hasn't really recovered, and in a place where there's so much uncertainty both on the domestic and the global side, there is a big question of how much that capex recovery will happen this year. So the fact that we are below consensus is not just because of global growth, but because also of domestic factors. That said, you're absolutely right. Policy has turned counter-cyclical. Also, rural consumption doing better. There is the whole China plus one shift of supply chain to India. So there are positives, no doubt. But things like rate cuts, things like excess liquidity in the system, these will take time to transmit. For credit growth to eventually pick up. So probably in the second half of the year, we will see that play through. But overall, we still remain bearish at 5.8%.
Okay, so the Reserve Bank will watch out for all that. I have to take a quick commercial break, but I need Anubhuti and Aurodeep's views as well on what the Reserve Bank might do with this GDP numbers, as well on other nuances that we have to watch out from the May 30th data. Back in a minute. Welcome back to Indianomics. I'm in conversation with Aurodeep Nandi of Nomura, Kaushik Das of Deutsche Bank, and Anubhuti Sahay of Standard Chartered Bank, all of them top-notch economists, and we are preparing ourselves for the GDP numbers, the fourth quarter and the full year GDP numbers for FY24-25 that are going to be announced on May 30th. Anubhuti and gentlemen, thank you very much for your time. Anubhuti, I just wanted your word also, because your growth numbers for the fourth quarter are weaker than consensus. You are standing at 6.5, as you just defended. Do you expect that there is a chance that if there is a negative surprise, the Reserve Bank can push to 5-quarter?
I think, Latha, I mean, probably we will have to wait a little bit more before we start penciling in a 5-quarter kind of repo rate just as of now. At this point in time, I think terminal rate of 5.5% looks pretty good. There is definitely a lot more room when you are simply focused on inflation. There is a lot more room to cut if you are focused on the global uncertainties. But if we have to go towards 5-quarter or 5%, I think the trigger has to come from GDP growth numbers over the next few quarters. And there are viewers that while the current momentum has not been good, there can be few offsetting factors which can make FY26 look not as bad as what we are anticipating at this point in time. True, there is global uncertainty, but at the same time, as you mentioned earlier, policy has turned counter-cyclical. 100 basis points of rate cut immediately gives a saving of 0.3% of GDP to whoever has borrowed. And I'm only talking about the retail borrowers. I'm not talking at a economy level. The tax cut, which probably has faded away from our memory, that's another 0.3% of saving in the hands of consumer. It might not translate on a one-on-one basis in terms of increased consumption, but it definitely protects and and defines a floor when it comes to GDP growth numbers. So our sense is, unless GDP growth for FY26 starts showing signs of slipping below 6%, till that point in time, 5.5% looks like a decent repo rate to bottom out at, especially given the very aggressive stance which RBI has taken on liquidity infusion.
Okay. No, I polled a dozen economists, all top-notch. So my sense is no one gave me that bearish a number. The only 5.8 we got from Nomura was for the full year, but otherwise we haven't got a sub-6 number. So perhaps the Reserve Bank's hand need not be pulled. But Kaushik, what is your sense about any further informal sector data and therefore that coloring the GDP numbers? Because now the MOSPI is much better equipped. You've got monthly PLFS numbers and you have got this unincorporated as-used number. So do you think that can anyway impact positively or negatively the GDP number?
So, Latha, first of all, we are not very negative on GDP growth relative to our peers.
Yes.
So we have 6.5% growth, and one thing which I should...
1 minute. You have 6.5 for the current year?
For FY26, yes.
Okay, you stand with the Reserve Bank there. Okay.
And remember, RBI reduced the growth forecast from 6.7 at a time when there was peak negativity about global tariff. And since then, a lot has changed, and there's been a reversal. IMF also cut the global growth from 3.3 to 2.8 when there was peak negativity. Now, a lot of people are considering whether growth can be higher in China from the peak negativity that we have seen, or in US. All these discussions are taking place. So it is possible that maybe RBI wouldn't have cut from 6.7 to 6.5 if the reversal had already happened. So we are comfortable at 6.5. To your question, informal sector data obviously makes the data set more robust. Normally, the data have been revised higher after incorporating all the broader set of data from the provisional data. So I would think that going forward, there could be a bias of revising up the forecast of the previous quarters as well. Also, one thing you should remember that April to September, the government will be spending their 11 trillion capex in the normal trend like each year, compared to last year, April, September, where they could not do much because of elections and then heavy monsoon. there'll be a big year-on-year bump on government, spending-related growth in April, September. Plus, what Anubhuti said, I think it's very good news for the consumers that inflation has come off. Tax rates have been cut, so real disposable income has increased. Monsoon is supposed to be above normal, so that's good for rural, growth. And RBI has flushed the system with liquidity for allowing transmission to happen. Also, the bigger medium-term story is that India is cutting tariff rates in a big way, not just with UK, they'll cut with US, with Europe, New Zealand. So that's very good news for the consumers because inflation comes down in India over the medium term because of the tariff rate cuts. And that's like extra, additional savings with them, which they can spend going forward. So I would not be very negative on India's growth at this stage, given the reversals that have happened with the tariff. India probably will manage 6.5% growth this year and next year as well. But the only thing is that India's potential growth rate is probably 7% or higher. So relative to that, we are still on the lower side. And that's why we think RBI can probably come down to 550. 100 basis points rate cut becomes meaningful to allow transmission to happen, but nothing more than that, because the deeper you cut and then if you see inflation or growth going up after a few quarters, market will pressurize RBI to reverse those rate cuts if you go very deep in the rate cut cycle, which then creates a problem for RBI, because once you finish the rate cut cycle, you would want to wait for 1 year or 15 months before you start the rate hike cycle. So I think 550 is an appropriate terminal rate, but after June, I anticipate a pause in August, because you'll already get a 50 basis points rate cut through liquidity and repo, and then probably in October, the last rate cut.
Yeah, well, I have to rush to wind this down. Aurodeep, all points taken about, the liquidity flush and the tax cuts and what Anubhuti and Kaushik are pointing out. But, there is uncertainty. Investment comes only when there's certainty. And that certainty has been very rudely shaken. Even after the reciprocal tariffs have now become more rational at 30%, I don't know how much investment will happen. And even the government's capex faltered. When you started looking at December, January, they were not, January, for instance, was not as good, although there was no election to pin it on. So therefore, do you think that, investment, just give us an idea of what you're expecting in terms of consumption growth and GFCF, that is gross fixed capital formation, anything that you want to train our eyes for the May 30th numbers?
So on the, if it's about FY26, then we expect consumption growth to weaken. Yes, there are positives, but we also need to consider that even things like rural consumption. Yes, it's picking up, but if you look at the rural indicators, you've got two-wheelers doing badly and some other tractors doing better. So it's not even the rural recovery is uneven, and our own analysis on rural terms of trade has been that it's going up, but it's going up and down also in that trend. You're absolutely right on the investment side of things. Even with tariffs possibly lower, there's still a lot of uncertainty. There's a lot of uncertainty on what kind of tariffs India will negotiate with the US, or the US will negotiate with China. If that is dramatically low, then will the China plus one model still hold? So I think there are a lot of ifs and buts. And in such a scenario, in the absence of strong domestic demand, it is natural that private capex sort of takes a backseat. A lot of focus will again remain on government investment trying to drive the engine. So maybe for investment, we are expecting it to sort of pick up this year compared to last year, which was really bad, as Kaushik mentioned. But I think overall, because consumption is on the weaker side, because global growth could be weaker, because of higher uncertainty, we are on the bearish side on growth.
Fair point. Actually, there are enough factors to be bearish, to be fair, that even urban consumption was stagnating. There were several indicators. And, uncertainty always means that the businessman will not open his purse. But there are positives in terms of defense, actually, as a propeller. In the past, we've always seen post-war-like scenario, there is a kind of an investment cycle pickup. So we could see some positives from that very unfortunate event as well. Let's see what May 30th throws up for us in terms of trends in Q4 and all of FY25. Thank you very much, Kaushik, Aurodeep and Anubhuti for participating in this conversation. That's it on this edition of Indianomics. Thanks for watching.